Welcome to the Brain Picker Pro Show, live from Lake Wiley, South Carolina, and all the way down somewhere in Florida, relaxing, vacating, and having fun and making money at the same time is my good, long-time old friend, Carl Fischer from CamaPlan. What's up, buddy?
Not too much, man. Like you said, just trying to get on vacation, trying to get over to the Bahamas here. We're taking the boat out and going there and fishing for 4 or 5 days.
Are you really? And
I
I
am.
wasn't invited? What's up with
No,
that?
you were invited, but you were watching fireworks and, loving the 242nd birthday of the United States. You know what I mean?
That's funny. Man, I hope you guys catch a lot. I hope you do. That's awesome. I can't wait to go myself.
Well, let's set up a time. I've told you to do that. Bring Pam and Noah, and we'll just go out and fish, and it'll be a great experience for everybody.
That would be a lot of fun, man. I'm telling you, the biggest fish I ever caught was with you. Down in, where were we, in Cabo?
Cabo San Lucas, yeah.
Oh, man. Now, guys, this guy, Carl, he knows how to fish. He is a legend. I'm telling you, not just in real estate and in self-directed retirement accounts, but he is a legend fisherman, that's for sure. I'm telling you, I've never had so much fun fishing as when we went down in Cabo. And you know how to cook them, too, that's for sure.
Yeah, we were eating fish for 3 days, I think.
I know, right? There was a bunch of us staying down there in a condo in Cabo San Lucas and hung out over at Sammy Hagar's place, Cabo Wabo, for a while. That was a lot of fun, wasn't it?
It was. That's what I say. Let's get down here, let's go fishing.
There you go. That's awesome. That's awesome. So let me do a little introduction here. I know we've just been kind of catching up while we're recording, but guys, Carl Fischer, nobody knows more about self-directed retirement accounts, retirement plans, tax-deferred, tax-free, types of accounts, all this stuff than Carl Fischer. I've known him for many, many, many years. I am a client of his, gone on vacation with him and his family many, many times. And I had to get him on here, and it's hard to get him scheduled because he's now got a lifestyle where he don't have to work every day, right? So I'm catching him on vacation just before he goes out on the boat, right, Carl?
That's exactly right. I actually forgot we had this interview this morning, and it popped up on my calendar. So I pulled the truck back in and came back in to do this, and then I'm leaving.
You were already on the road, headed to the boat, huh?
Pretty much, and then this popped up.
Oh, man. I'd a lot rather be with you there than doing this interview.
Well, we'll set it up for sure.
So, Carl, tell our listeners a little bit about yourself, about your real estate investing, and then we're going to talk about self-directed and investing tax-deferred and tax-free.
Sure. My whole family started out in real estate. My mom and dad, their moms and dads were in real estate. So I was basically born into real estate. And a matter of fact, I just seen an article back in 1934 for my uncle opening up the first Broadway Realty office in Newark, New Jersey. That came out 2 weeks ago from my one of my cousins. So very interesting there. So I ended up being in real estate because I grew up around it. I graduated, as an engineer, and then did rocket science work down at Kennedy Space Center. But all along, I was buying property, not only for my own home, but for rental and for resale. And I've just liked getting into real estate. And then when my dad died, I actually learned about self-directed IRAs and turning real estate income into tax-free income for life. And that's how I transitioned out of rocket launching into self-directed IRAs.
So, Carl,
pretty much that simple.
It's an accurate statement to say you really are a rocket scientist.
Well, I was. I'm not out there anymore, but I do watch them. But yes, I used to launch on the shuttle and some of the military secret launches.
That's awesome, man. I love that. I love that. So let's start out first. Tell us about tax-free investing, about, because not a lot of people know that you can use, a retirement account or 401k or HSA, whatever it is, that you can buy real estate. So tell us a little bit about maybe the different types of accounts and we'll kind of go from there.
Sure. Well, let's first talk about tax-free accounts versus tax-deferred accounts.
Okay, good.
Right. And like a traditional IRA, which were the first IRAs that were introduced back in the 1970s, they're all tax-deferred. But what that means is when you put money into them, you earn money at your job, you put money into them, and you get a deduction for putting that money into an IRA or retirement account. Right. And then whatever you invest in along the way, up until you're 70 and a half or 59 and a half and start taking it out, all that money accumulates without having to pay taxes. So you have more money to invest. But then when you do take it out at 70 and a half or 59 and a half, depending on your circumstances or any time in between those, you have to pay tax on that money.
Right.
It's still a good deal, but I don't know what the tax rate's going to be when I pull money out. So I personally prefer the tax-free account, or a lot of people refer to it as a Roth account for the senator out of Delaware that put it together. Right. And those were introduced in 1998. And what that means is when you put the money in, you don't get a deduction for it. You pay the tax right then to the government. But then everything that accumulates after that, all the earnings on that money is tax-free. So if you buy a piece of real estate, let's say a single family home, and you pay, $50,000 for it today, and in 10 or 20 or 30 years, it's worth $500,000. In the Roth IRA, you won't pay any taxes. In the tax-deferred account, you'll pay taxes on that $500,000.
So, what are the different types of accounts?
Yeah, so the Roth account is a Roth IRA, which is a personal account. The Roth 401k is a business account. The health savings accounts are great because the money going in is tax deductible, and anything coming out for medical expenses is tax free. So those are really good. Then you have the traditional IRA, which is tax deferred. You have a SEP or a simple IRA, which is also tax deferred. And you have a educational savings account, which is a lot like a 529, but you can self-direct the educational savings account, and that's another tax-free account. So you have a difference between the tax-free and the tax-deferred accounts.
That's awesome. And I'm writing down notes as I think about stuff to do. Let's talk about, most everybody knows about an IRA, right? Or 401k, that sort of thing. What do you think is the best type of an account to have?
Well, I have several. Okay. I think they're all good and they all have a certain place to go for it, and use. I personally love the Roth IRA. But sometimes you make too much money to make a contribution to that, so you have to use what they call the backdoor IRA, which is putting money in a traditional IRA and then converting it to a Roth. But if you use a Roth 401k, you're allowed to do that no matter what your income is, and you can put more money into that. You can put up, in my case, I'm allowed to put $24,000 into the Roth portion of a 401k because I'm over 59 and a half. And then I have several ESAs, educational savings accounts, for my children, or my grandchildren, I should say. My kids are out of college now. And then obviously I have the health savings account. Next year, I'm not going to be able to contribute any more to that, but I've taken that account and I've bought notes with it. And those notes will bring me enough money every year to pay my deductible and, whatever I have to do on Medicare. And I'm not even sure what to do with that yet. We're just figuring that out.
So let's break down a couple of these. Let's talk about the HSA first, health savings account. The cool thing about a health savings account is that it's not use it or lose it. You can build that account up and then reimburse yourself tax-free for what's called qualified medical expenses that you had 5 or 10 years ago, as long as the account was open then, right, Carl?
Yeah, absolutely. I opened up my account, 10 years ago. I think I've got, 60, 75, 80,000 in it at this point in time. I probably have, I don't know, for 10 or 15 years, whenever it came about. Well, I guess it hadn't been that long. It's only been about, I think it came out in 2006, but I didn't get into it in 2010 because I didn't understand it. So I've had it about 8 years, and I have a note in there that just keeps making payments to me every month. And I have my medical expenses, whatever I paid for physicals. Vicky had a couple of heart problems and things like that. And, so I think we've got like $25,000 or $30,000 worth of medical expenses over the past eight years. So out of that 70,000 that's in my account, I can pull that 30,000 out at any time by just requesting a distribution. And if the IRS asks me about it, I just show them my receipts, right, from the medical expenses. And 8 years ago, I put all my medical expenses, I gave Vicky a card and myself a card, and we put all those expenses on a credit card. So all I really have to do is look at those credit card receipts and things from the last, from the last 10 years or 8 years from 2010 forward. So that's how I'm tracking all those expenses.
That is awesome. That's really, really good. I never thought about that. But also, what Pam does, my wife, what Pam does is she has a binder, right? She has a binder with everything that, every medical expense, even when we go to the doctor, she tracks the mileage, because mileage is also a qualified medical expense as well, right?
It is. Yep. All that stuff is there. Massages, etc., are all on there. I'm not down to that level, but sorry about having my face off of there. But I'll just show you. This is a card I carry right here. Can you see that?
Yeah. Don't be showing that card number.
Yeah. Okay. Right. But I put that medical thing on it so I don't use it for anything else.
Right.
When I'm using it. But Pam's a lot better record keeper than me.
Pam is hardcore about keeping track of things, right?
Yes,
I mean,
exactly.
you know how hardcore she is about being organized. I mean, all of our cans in the pantry are faced the same way, right?
Yeah, probably. Yeah, I should have her visit Vicky more. Don't let him watch this video.
I know, right? That's good. So that's an HSA, but you also have to have what's called an HDHP health plan too. Tell us about that.
Yeah, I mean, most people can talk to their employers or their insurance providers, which are, and they'll tell them a high deductible health plan is there. And high deductible used to be used to be up in the couple of thousands. Now you can get them as low as $1,500, I think, and maybe even $1,000 if you're single. But you just ask your insurance provider or tell them, hey, I want a high deductible health plan that I can have an HSA with. And the reason I liked it was my premiums were cut in half, and I was able to make tax deductible contributions to the health savings account. So I was saving money on both sides of the equation. And because I was fortunate enough to be able to pay any medical expenses out of pocket, I just kept all these expenses so that if I do want to have a motorcycle or buy your Harley, I can now take it out of my HSA and not be taxed on it, have a tax-free Harley.
Yeah, as long as your doctor says that you need a Harley for therapy, right?
Yeah. No, I don't even need it because I've got all those old receipts I paid for.
Right.
Doesn't even have to tell me. Yeah. But yeah, no, he did say I needed a Harley to relax myself and keep my blood pressure in check.
I love it, man. Mine's in the shop right now. I can't wait to get it out.
But yeah, you're missing some good driving days now.
I know, right? It's been in the shop for about a week, some kind of recall. But
yeah.
So let's talk about ESAs. You mentioned you had ESAs for your kids, but now your kids are grown, and so talk a little bit about ESAs, but also how you can continue to move that from person to person that may need it. It can go on forever and ever.
Okay. As an example, my kids are all grown, but you know what happens when your kids get grown?
They have kids.
Exactly. And I think you're in that same boat. So, so the only thing I don't like about them is the contribution is only $2,000 a year per child, but I have 5 grandkids now, so I can give $10,000 a year, put it in there, and all that money grows tax-free. It can be used for kindergarten, first grade, elementary, high school, college, and post-college work.
Until they're how old?
Until they're 30 years old.
Right.
Okay. But what happens, and we've got many clients, whose parents put money in for them, and as they grew older and they got out of school, anything left in their ESA was transferred to one of the younger siblings. And when the youngest ones get out, they transfer them now back to the older siblings' kids or their own kids. So, as an example, my son, who's now one just turned 30, he had money left over because he got a scholarship. He gave money to his he put that money into his daughter's ESA.
That's great. Now, do you just transfer the ESA, the name on the ESA, or does he actually pull it out and then start another one for his daughter?
No, you just change the beneficiary on the ESA from yourself
him to her.
Yeah.
That's really good. That is really good. I really like that. All right, let's talk about the type of investments that you can do in a retirement account.
Well, not only retirement, but these ESAs and HSAs.
Yeah. I mean, all of them. Yeah.
All of these accounts we've been talking about. Like I said, I primarily am a big real estate person, and you know that. As I'm getting older, I'm transitioning from real estate into loans and mortgages,
notes.
Notes, which I think you're familiar with.
Right.
There's also some private placements and some funds that you can get into that, put a bunch of notes together or a bunch of real estates, a little bit like a REIT, some other investment funds that just what I call is mitigate the risk because you're doing it over a lot of different pieces of property or notes. So we call those private placements. And then, of course, there's gold and silver and precious metals and, there's sports tickets and personal property and loans on cars. I pretty much don't want anybody doing uncollateralized or non-secured loans.
I don't blame you. And there's a lot of stuff that you can do in a retirement account as well. It's not just notes and real estate, right?
No, it's whatever you're thinking about. I mean, tax liens, notes. What else is out there? There's accounts receivable that people use. There's tax deeds that people buy. There's options, right? Whatever you can think of, basically, except alcohol, life insurance, and collectibles is all due. I mean, we've had people buy llamas. We've had them buy racing horses.
Right.
So there's, whatever you're good at, that's what you kind of want to figure out to invest in. There's vertical farming that's been out there that's been looked at. So there's a variety. Whatever you're good at, that's what I think you should try to turn into tax-free income for life. Intellectual rights,
right?
Patents.
There's so many things you can do. Talk a little bit about prohibited transactions and disqualified people.
Okay. Yeah, I hate to talk to people about things like that, but one of the things, like I said, you can't use alcohol, life insurance, or collectibles such as antique cars, coins, precious metals that are collectible, numismatic ones. But the other thing that you can't do, and you mentioned it, was disqualified people. So if you are if you have an IRA, you can't deal with yourself. Your IRA can't buy a property or lend money to your spouse or your parents or your kids, any lineal ascendants or descendants. Those are all disqualified people. Any fiduciary you have or partner you have is also a disqualified person. So you don't want your IRA buying or selling or lending or doing business with any of those disqualified persons.
Right. That is very important.
Yeah. So you want to keep away from that. You don't want to be living in any of your properties that your IRA own. You don't want to be doing any sweat equity in those properties because that's considered prohibited, because basically you would be contributing to your IRA over the limits that were allowed. So those types of things are out there. I basically tell people, if you're getting a benefit from what your IRA is doing now, then it's most likely prohibited. And an example of that is if you're a real estate agent and you're selling a piece of real estate to your IRA, you can't take a commission off of that sale, because then you'd be getting a benefit right now from your IRA doing that transaction.
Yeah, like you said, the most important thing to remember is you can't personally benefit from your retirement account.
Right. At this time, obviously, when you retire, it's fine.
That's good. That is good. So talk a little bit about leverage, because you can buy real estate and even borrow money on that real estate if your IRA doesn't have enough money to pay for the whole asset, right?
Yeah, no, I love that aspect. It's really the only way you can take an IRA and leverage it that I know of. And what do banks love to lend on? They love to lend on real estate. As a result of that real estate, whether it's in an IRA or not, banks a lot of times will lend on it. It has to be a non-recourse loan because the IRS makes that the rule. But a lot of banks have gotten on board with it and just reduced their loan to value down, to 70%. So therefore, you can borrow 70% if you've got 30% down in your IRA, and that's from a bank. Now, there's other people out there that have money sitting in, CDs at 1 or 2%, and if they can turn around and get 5, 6, 7, 8% by lending it on a piece of property that they can have a mortgage and lien on, if they don't pay it, they're happy to do that. So you can get that money from banks, you can get it from individuals, you can get it from other companies, you can get it from other IRAs or 401ks, Roth or traditional. So there's a lot of ways to fund a purchase of real estate in your IRA if you don't have it. You can also partner with a couple of other IRAs. But I'd be remiss if I didn't tell you, Larry, that one of the things, if you do use your IRA for this and you do get a loan, there's a good probability that you'll have to pay what's called unrelated business income tax or unrelated debt financed income, which is at trust rates. But I tell people not to worry about that, because if you're in that situation, you're making good money, and if you do it in a Roth, it's going to be tax free for life. after you pay that UBIT if you have to do it. But you get to take the expenses, the depreciation and any interest expenses, et cetera, off of that number. So you're only going to pay tax on 70% of the income if you had a 70% loan to value. If that makes sense to you.
It's a ratio. Like if you borrow 50%, you're going to pay taxes on 50% of the income that the asset brings in.
Right, minus the depreciation and any other expenses.
Right, because if you have UDFI, you can take the depreciation then.
Yes, absolutely. 70% of it, that ratio, you can take that ratio of it.
Right. Very good. That's good. Man, this is really, really good stuff. Now, talk about flipping houses, wholesaling houses versus long-term investments in an IRA, because the IRS doesn't want you to create a business in your retirement account or any of your tax-deferred types of accounts, right?
Yeah, you have been listening and paying attention over the past few years. You seem to know a lot about this. One of the reasons you get the deduction for real estate in your IRA is because they want people to own real estate and have that as one of their assets going into retirement, because it seems to be one of those that pan out and people make money with. So some people say, well, I'm flipping these houses, and they're doing, 15 or 20 houses a year. And the IRS says, well, that's not a long-term hold for your house. What you're doing is creating inventory with real estate, a lot like Macy's does with suits or dresses. So you're actually a business. The houses are not assets, but they're inventory. So it looks like you're in a business for profit, and the IRS said it's all right to do that, but you're going to be paying that unrelated business taxable income. And if you do that, that goes up to 39% after like $15,000. So if you're already in the maximum tax bracket, I don't see any reason not to do it. But if you're not in that max tax bracket, then you could be doing this outside of your IRA and only paying 10, 15, 20, 30% tax versus 39% tax. So don't make these things a business, because unless you're making a lot of money and you're already in the top tax bracket, then you can use your IRA or Roth IRA as a business and pay the tax on it and continue to grow your IRA. But it is something that you need to watch out for. But people always say, well, it's illegal to do that. It's not illegal to do that. You just have to pay a tax on it. Now, people will buy 3 or 4 houses and own them and get rent for them, and and then buy the 5th house and find out that they don't like it, or it's in a neighborhood that they don't want to be in, or they need to do a repair on one of their other properties, and they end up selling that house, and they might not have owned it for a year yet, but they turned around and quote flipped it. But their intent wasn't to flip it. Their intent was to keep it. And if you do one like that, or 2 a year, depending on what your other assets are, I don't think the IRS is going to say anything negative about you for that. It's not business.
Right. In fact, that's that's one of the IRS's guidelines is what was your intent when you bought it, right?
Exactly. And if you intend to keep it for long term and can prove that, then you're gonna be there. But it's hard if you're flipping 20 houses a year to say, hey, your intent was to keep it, unless maybe you're getting 100 houses a year and keeping 80 of them.
Well, you know what the $1 million question is? Everybody's going to ask, how many houses a year can I flip in my retirement account before I have to start paying UBIT?
What's your intent? A lot of CPAs say, oh, it's 4 before you're a business. But again, what's it look like to the IRS? What's it going to look like to a jury or a judge that's making a decision on this? if if you have a bunch of holds and you do 3 or 4 flips, if you've owned them for over a year and a day, now it's long term. So there's, that answer is gray in most cases, but you can definitely see the black and the whites like we talked about, but the exact number, there's never been a precedent set for that.
Yeah, it's kind of like if you're going to buy houses and sell or finance them and then sell the note, you're better off to lease option them for the first year and then convert it to a note and sell it, right?
Yeah. Yeah. I mean, that way you'd have it at least for the long term and then do it. Not only that, I like that option either, because if you sell the house, with a owner financing and they don't pay, then you have to foreclose.
Right.
But if you see them making the payments for a year, you can feel a lot more safer, or a lot safer giving them a note and a mortgage.
Right, because if they're going to default, most of the time, a lot of the times, they're going to default in the first year.
Right, and they're not going to be paying you their rent right.
Right. Man, Carl, this has been really, really good stuff. I don't want to keep you too long. We've been on here about 32 minutes. So tell us some parting words of wisdom and how people could reach out to you, because I'm telling you, guys, listen to me. I have known Carl for years and years and years, okay? I've got multiple accounts with Carl. If you were going to have a retirement account, an IRA, an HSA, an ESA, self-employment plan, a 401k, a safe harbor 401k, if you're going to have an ESA, an HSA, you need to reach out to Carl and get one right away. Carl, you even offer training as well, because you can't make investment advice, but you tell people and do podcasts and webinars and share with people all the different things they can do with their retirement account as well, right?
Yeah, no, we want people to be educated, so we put out a lot of educational webinars and series, and bring people in that are doing things real time, so that they understand it and allow people to go do their due diligence. One of the things I really want people to do is do your due diligence on any investment before you make the investment, not after it, not after they stop paying. Right. That would be my number one word of wisdom that I would put in there. The second thing, if people want to reach us, one of the best ways is to look at our website, CamaPlan, CAMAPlan.com. And if they want to call us, they can call 877-559-4430, 877-559-4430. We'll set up conference calls with your accountants and attorneys, so that you can get all your questions answered on this. Because as you said at the beginning of the show, Larry, not many people know about it. Not many people utilize it. Mitt Romney, when he was running for president, that was great when he released his tax return and it showed his $100 million IRA. We got a lot of publicity off of that, and a lot of people came to us, even though he didn't keep his IRA with us. They looked at it and found out about it, and so we did a lot of education at that point in time.
Yeah, that's how a lot of people mainstream found out about what's called self-directed retirement accounts, right?
Yeah. They've been doing it for the very wealthy, all the way, back many years, the unions and things like that. But for the common man, it wasn't really available. I mean, right now, most of the brokerage houses will do it for people, but you got to have $50 to $75 million to get one of these accounts. And they're more expensive with them than they are with us. So we kind of make this a low cost, available to everybody who wants to use their own knowledge and take control of their financial future, investing in what they know and understand. So we'll be glad to talk to anybody on this. Feel free to call our office. I'm pretty sure we're going to be closed tomorrow. I know I'm not going to be there, and I'm not going to be reachable out on the ocean. So if you want to talk to me, make it like a week from today.
There you go. That's good. Carl, man, I really, really appreciate you being on here today. It's been just a wealth of information, a wealth of knowledge. And guys, listen, go to CamaPlan.com or call the toll-free number Carl gave you and set up a time. Carl, I've never, ever, ever heard any custodian saying, we'll get on the phone with your accountant, your CPA, your attorney, and we'll explain it to them. I've never heard anybody even offer to do that, and that is huge. So I really appreciate you doing that.
Well, we want people to feel comfortable about it. You know, this was a company founded by investors for investors, and you know, we're totally transparent. We want people to understand that. We want people to understand exactly what they're getting into. And, you know, I'm not doing it all out of the generosity of my heart, because guess what? Once I convince your attorney or your accountant that this is what it is, they send us business for other people that are looking for that after we build a relationship and they feel good working with us. So,
That's
you know,
awesome.
this is a way for me to get business. And I appreciate you having me on today, and I love your show, and I love your our mutual clients.
That's awesome, man. Thank you so much. I really appreciate it. This has been really, really good, and I really appreciate it. So, guys, go over to CamaPlan.com and start opening up an account, or reach out to them, give them a call, and set up a time to get with them on the phone and open up an account. Whether you have kids or grandkids, or you got a retirement account, you don't have to move even the whole thing over. You could start out with moving a portion of an account. And even if you have a 401k, there's what's called an in-service rollover or transfer. You may be able to even roll a portion of a 401k even if you still work with a company, right, Carl?
Absolutely. And one of the other things, Larry, is I need to get you back on, because we're redoing our webinars and our educational podcasts, et cetera. So I would like to get you back on there and update it, because the economy has changed somewhat in the past few years, and I'd like to get your ideas and pass them on to our clients.
That sounds great, man. I'd love to do it. Looking forward to it. So you have fun out there fishing, and just be thinking about me while you're out there reeling them in.
No, I know you'll be there with me in spirit, just like I was there for you in the 5K run.
I know, right? I ran 3 miles this morning.
Yeah, and tell Pam that I'll bring her back some of that fish.
All right, that sounds good, man. She loved that fish, but she's allergic to it. That's why you said that, right?
That's exactly right. I remember that. You looked
awesome.
like the polka dot lady afterwards.
I know, right? We had a great time. All right, Carl, man, I really, really appreciate it.
Yep. Have a good day.
All right, thanks a lot. You too.